Sir, am I visible?
Yes, ma'am. Yes, ma'am.
So, am I audible too, sir?
Yes, ma'am.
Okay.
Okay.
So good afternoon to you all.
Good afternoon, sir.
Happy afternoon to one and all present here. Welcome to our
Good
second.
afternoon, ma'am.
Good afternoon, ma'am.
Hope you have a happy learning session today. We are waiting for Mr. Chawla to join us. So please be online for some time.
Hi, good afternoon,
Hello,
everyone.
sir.
Good
Good
afternoon.
afternoon, sir.
Happy afternoon, sir.
Madam,
just
very happy good afternoon to you.
I was just going to call you, sir. I'd taken the phone for that, and by the time I saw you on screen. I hope you
Actually,
have.
I thought that I'll join by 1:56. So,
Okay. Anyway, it's all right, sir. Have a great day. I have a
thank
meeting,
you,
sir.
madam.
So
Thank
I'll
you.
go for the meeting. I hope
I
you
understand.
continue.
No issues at all. No
Wishing
issues.
everyone a very happy learning process and time. Bye,
Thank
sir.
you,
I'll
madam.
catch up with you in the middle of the program, sir.
Surely, madam. Bye.
Yeah.
Have a nice day.
Bye-bye, sir.
Thank you,
Thank you.
ma'am.
Bye. Thank you, ma'am. Bye.
Good afternoon, sir. This is Ganapati.
Hello, sir. Good afternoon to you.
Sir, we'll start the session in another few minutes. Can we wait for some more participants? They are ready to join. They are on the way to join.
Sir, we cannot hear you properly.
Sir, can we wait for a couple of minutes?
Sure,
The
sure.
partic-
I'm absolutely.
Yeah.
I'll start once you ask me to start.
Sure, sir. Thank you, sir. Thank you so much. And one request, sir. Yesterday, I have received a call from various participants. They want to know what is the answer for the yesterday's questions.
Yes, so we'll be starting with that, sir. I'll be sharing that.
Yeah, thank you. Thank you so much.
Welcome, sir. Welcome.
Ma'am, Rajakshmi ma'am.
Yes, sir.
Shall we, ma'am, sir, shall we start, sir? It's, I think it's times to. Sir, Mr. Ravindra Singh, sir.
Yes, sir. I'm there. Yes, we can start. We
Yeah.
can start.
So, can you start?
Yes, ma'am, we can.
Okay, thank you. A very happy afternoon to our esteemed resource person, Mr. Ravindra Singh Chawla, our beloved principal and director, faculty members, researchers, and colleagues who have gathered here today. On behalf of SA College of Arts and Science, I, Rajalakshmi from the Department of English, welcome you all to day 2 of the 7-day online faculty development program on cognitive analysis in financial services, organized by Internal Quality Assurance Cell, IQAC, in association with the School of Commerce and Management, SA College of Arts and Science, Chennai. The great Greek philosopher Aristotle once said that something that is well begun is half done. As the saying emphasizes, we had a comprehensive and illuminative session yesterday on the topic Introduction to Financial Planning. It was quite apparent from yesterday's session that there was so much takeaway. Today, our resource person, Mr. Ravindra Singh Chawla, founder and managing partner, RSC Skill Building and Consulting Solutions LLP, will address and enlighten the gathering on the topic Investment Management, Equity Markets. I'm sure there will be great takeaway from today's session as well, sir. And I would like to remind all the participants to stay with us till the end of the session. And please don't forget to post your queries in the chat box and attend the quiz that will be posted at the end of the session. And now I would like to call upon our resource person, Mr. Ravindra Singh Chawla, to address the gathering. And I wish all the best to all the participants. Thank you, sir. Sir, it is an honor and privilege to have you with us today. Thank you. Over to you, sir.
Thank you so much, madam. I appreciate, really thank you for the kind words. It's indeed my privilege for this opportunity of being here with you all. Let's quickly start with the scores of the quiz for yesterday. There were around 50 odd participants who scored full marks, 515. So I would want to share the names of all those people. Just give me a minute, please. Okay, so this is the Excel sheet. What I've done is that I have arranged these scores in the in the order of time that we received when those answers were submitted. So like you could see Dr. Sudarshan Kasa, he was the first one to submit the answers, and all the answers were correct. So congratulations to all of you. Dr. Sudarshan Kasa, Ms. Maria, Dr. Pandurangan, Tusita Raja Iyer. You could see the names mentioned here. I'll just gradually move the names. So we have arranged it in terms of the time that we received it. There were quite a few participants who submitted answers more than once. So they submitted the quiz again and again. I would humbly request you not to do that. Once you have submitted the answers, kindly do not resubmit it, because it adds to the task at our end, sorting the marks, etc. So we can discuss the correct answers the next day, and just in case that was the query, that is the query. So just to share with you the other names also. So great, heartiest congratulations to all of you. You've scored full marks, 515. Okay, another request. Some participants have mentioned, their email IDs against the column for name also. Like, for example, you could see some participants, they mentioned their email IDs. Kindly do not do that, please. Kindly mention your name, because, all these scores would get utilized for working out the eligibility for the certificates. So minimum 50% marks are required, cumulatively speaking, in terms of for eligibility for the certificates. So kindly request you not to put your email IDs, request you to put your names in the names column. And if you have written the name, full name in one particular quiz, kindly mention the same name in the next quiz also. Because if the names are different, then it would become difficult for us to accumulate the scores. I'm sure you can understand that. So more names. So fantastic. I think the response was overwhelming. Really appreciate that. Another request, kindly submit your answers, by 5 o'clock. Kindly do not delay it beyond 5 o'clock, because it will not take you more than 2 minutes submitting the answers, right? There are just 5 questions, and these are all MCQs. So actually, it will not even take more than 2 minutes. So if you know the answers, you can immediately do that. But kindly do not delay it beyond 1 hour, please. So these are the names who scored full marks. We have only taken those scores which which pertain to the submissions that were sent first, right? So let's say if I had submitted a particular I had submitted the answer, and the score was 3, and again I resubmitted it, and then the score was 5. So my first score was considered, the second score wasn't considered. So request you to only submit the answers once. Kindly do not submit the answers twice. Okay, I believe, in fact, I also saw that everyone who not score full marks. They made a mistake in the last question. So I will explain what it is all about, concept. I'll write it here itself so that we save on time. I hope this sheet is visible to everyone, right? You could just write in the chat box if you can see the sheet. We just write why. Okay, fine. Thank you. So the question was that last year, this gentleman's assets, right? Assets were 2 crores. 2 crores, right? This year, his assets have grown by, so assets were 2 crores. Sorry, net worth was 2 crores. I beg your pardon. Net worth was 2 crores. This year, the assets have grown by 10 lakhs and the liabilities have reduced by 2 lakhs, right? So let's assume a situation that last year the assets were 2 crores 20 lakhs, right? Sorry, 2 crore 20 lakhs. 2.2 crores. Those were the assets. And let's assume that the liabilities were 20 lakhs. Right? So the assets were 220 lakhs, 2.2 crores, and the liabilities were 20 lakhs. Right? Which meant that the net worth was, since net worth is equal to assets minus liabilities, which meant that the net worth was 2 crores. Correct? Now let's assume, since the question says that this year the assets have grown by 10 lakhs and the liabilities have reduced by 2 lakhs. Okay? So this year, the assets may have become 2 crore 10 lakhs. Sorry, 2 crore 30 lakhs. Right? Assets have grown by 10 lakhs. So last year, the assets were 2 crore 20 lakhs. So this year, the assets may have become 2 crore 20 lakhs. Right? And the liabilities have reduced by 2 lakhs. So the liabilities, let's assume, may have become 18 lakhs. Right? So net worth would be 2 crore 12 lakhs. Right? Simple. Mathematically, if we were to look at it mathematically, right? So the assets last year were 2 crore 20 lakhs, assuming, right? And the assets have grown by so the assets have grown by 10 lakhs, right? And the liabilities have reduced by 2 lakhs. And since we know that net worth is equal to assets minus liabilities, correct? So this will become minus. And since the liabilities have reduced by 2 lakhs, it will become minus 2 lakhs. Right? So mathematically speaking, I'm sure you can recall your mathematics days in school, right? So this will become, when we look at the answer, this will become, okay, I'm sorry, I made a mistake somewhere. Sorry, this will be, the liabilities were 20 lakhs, no? The liabilities were 20 lakhs, so now the liabilities will become 18 lakhs. I'm making a mistake. Let's take another example. Let us assume that last year the assets were 1 crore, 2 crore 50 lakhs. Okay, assets were 2 crore 50 lakhs, and the liabilities last year were 50 lakhs. 50 lakhs. Okay. So the net worth was 2 crores, 250 minus 50. This year, the assets have grown to 260 and the liabilities have come down by 2 lakhs. So the liabilities have become 48 lakhs, right? So the net worth will become 2 crore 12 lakhs. Another way to look at it is, since the liabilities have gone down by 2 lakhs, practically speaking, the net worth would increase by 2 lakhs, right? On account of reduction in liabilities. Plus, since the assets have also grown by 10 lakhs, the net worth would grow by 12 lakhs. I hope this stands clarified. Please let me know if the doubt still persists. Please let me know in the chat box. Is the doubt, does the doubt stand clarified? The question in the quiz? Okay. Okay. I mean, others also, please, if you could mention it. Okay. Thank you. Thank you. In case somebody is still not clear, please do let me know. I would be happy explaining it. Remember, net worth is asset minus liabilities, right? So if the assets have gone up and the liabilities have come down, then practically speaking, net worth would also increase towards that effect, right? That is what, as investors, we should try and focus on. We must focus on increasing our assets and reducing our liabilities, right? That is another reason why we must try to take loans only for appreciating assets, right? Those assets whose value would increase. For example, which are the appreciating assets? Please write down in the chat box. Which are the appreciating assets? Yes, property, land, right? All these are appreciating assets. In fact, education also. Education also. So, for example, let's say someone takes educational loan. Maybe you want to pursue, some course from IIM Ahmedabad, for example, or Indian School of Business, right? So, if you want to pursue, somebody's mic is on. If you could mute it, please. Thank you. Still not muted. Right? So, education. There's the sound of a crow. Anyone kindly mute your microphone, please. All right. No, still not muted. Sir, if you could help me, please.
Yes, sir, it's done.
Thank you. Thank you.
Sorry for the inconvenience.
No, not at all. Not at all. Sometimes the unmuting happens automatically also. I can understand that. So this is how we need to focus on. Yeah. So educational loan is also something which would really help us appreciate ourselves, right? But the loans for depreciating assets are for example, car, TV, washing machine. All these are depreciating assets. Great. So let's begin today's session. I'll just connect the presentation. Okay. So this is going to be a very important session because this would set the tone for our tomorrow session. And tomorrow would be a little more advanced level as compared to today. So let me ask you, what are your expectations in terms of investment management in equity? Can you write into the chat box, please? Any expectations, please? We'll be learning about the technical, fundamental and technical analysis tomorrow. Tomorrow, we shall also be talking about the financial ratios. Okay, let's look at the objectives today. So today we shall learn about what's the difference between investment and speculation. We should also learn about how do actually equity markets work. So we will learn it with a case study, a very simple case study. And I'm confident that it would help you understand the basics about equity markets. We should also look at the risks in investments, right? What are the risks in investments, and what are the cognitive biases in investors, because of which the investors may not be able to take the right decisions, right? And the common terms related to equity markets. So this is what we should be learning about today. Okay. Just to set the tone in a lighter vein. As we know, the skills are very, very important, and equity market skills pertaining to equity markets are very important if we want to create wealth for ourselves, right? So not only this is going to be helping us from our own investment perspective, but also from the perspective of supporting our students create wealth for themselves. Okay. Now, who are the regulators in the financial services? So we know that RBI is the regulator for banks. We know that SEBI is the regulator for the capital markets and mutual funds. IRDA regulates the insurance sector, and Provident Fund Regulatory Development, Pension Fund Regulatory Development Authority regulates the NPS sector, National Pension System, right? Somebody's mic is on, please, if you could mute it.
Participants, please unmute yourself. Sorry, mute yourself.
Thank you. Thank you. All right. So SEBI is the regulator for the capital markets. Okay. All right. Let's begin with a case study. Okay. So this case study pertains to Jaya and Kumar, who are married, right? And they work in the same organization. Okay. Now they differ, although they are a couple and they have had love marriage, but they differ in terms of their investment approaches, right? While Jaya is known to be an investor, she's an investor. Kumar is, he himself acknowledges that he is a speculator, right? So Jaya is an investor and Kumar is a self-confessed speculator, right? Now, my question is, how do you think both would be approaching their respective investments and speculations differently? What exactly would they be doing differently? Kindly write in the chat box. And I will request everyone to participate, please. Yesterday, we had very good participation, but from certain participants only. They were regularly participating. While I would definitely request all those people who were regularly participating to continue doing that today, but would also expect other people also to participate. Right? Because see, you guys have all of you, you've got a lot of bright ideas, and I'm sure all of us can get inspired by those. You can learn from each other. Okay. So Kumar is a risk taker, yes, and Jaya is a risk averse person. Okay, fantastic. Kumar is more risk taker than Jaya. Fantastic, very good. Other thoughts, please. Jaya, would be having expectations of a modest return on investment, and Kumar would be expecting very high return on investment. Fantastic, fantastic. Madam, who would be focusing on long-term investments? Yes, Kumar for short-term and Jaya for long-term. Perfectly right. Absolutely right. Yes, madam, perfectly right. Jaya would have been focusing on long-term investment. Perfectly right. Awesome. Very good. Thank you. Great. So let us look at the difference between investment and speculation. Right? So investment is more from the perspective of taking informed decisions after proper analysis. Right? Anyone who is an investor would not take decision only on the basis of emotions, would not take decisions only on the basis of, what others are doing, right? That person would take will try to take informed decision after thorough analysis, right? Whereas a speculator may only focus on hearsay, what others are saying, or what others are doing, right? Herd mentality is more applicable for speculators. Plus greed also, right? Speculator would be very greedy. The speculator would be wanting, to achieve success in a very short term, right? So the speculator may have been wanting to double his money, maybe in 2 years, 3 years time itself, right? And would be wanting to take excessive risk, right? Whereas the investor would be more patient. Plus, another thing, the speculator would be wanting returns in a short period, whereas the investor would be wanting decent returns over a period of time, right? So the investor would be more patient than the speculator. The investor would want a productive growth, right? Whereas the speculator would be taking a punt, right? I mean, if it happens, it happens. If it doesn't happen, it doesn't happen. It's like taking a bet, right? So if you get it right, you may be getting a huge amount. Else, you probably will not get your money back. Or even if you get something, you may get a small amount. But the speculator is happy with that, right? Investor would want a productive growth. Okay? Investor's attitude is more cautious. The investor wouldn't want to, take a decision, without any information, because the investor realizes that the risk may be higher. Whereas the speculator's attitude is aggressive, right? Again, the level of risk which all these things were pointed out by you all. It's a fantastic, great job done once again. The investor level of risk which he or she takes is moderate to high, whereas in case of a speculator, it's extremely high, right? Another thing, examples in case of investment are stock market, bonds, mutual funds, etc. Whereas in case whereas in case of speculators, it is cryptocurrencies or betting or futures, right? Or investing in IPOs only for listing gains, right? There are a lot of people these days who are investing in IPOs just for listing gains, right? That is speculation. So hope this would have become clear, right? Now, as we discussed earlier yesterday, the asset classes for investment. So broadly speaking, the asset classes for investments pertain to equity, right? Real estate, fixed income instruments, gold, etc. Right? Now, we shall be learning about equity markets today and tomorrow, and we shall be learning about the debt market day after tomorrow. Right? Real estate and gold is what we shall not be talking about.
சரி வாங்க அதுல ஹெட்செட்
Meera, madam, you may kindly mute. Madam, can I request you to mute everyone, please? We may
Yes, sir.
unmute
Yes,
the
sir.
participants towards the end.
Yes, sir. Yes, sir.
Thank you.
Participants, kindly cooperate with us. Please mute yourselves.
Thank you. So just to talk about it again, okay, can anybody recall what is Trinity of investment? We discussed. Awesome. Absolutely right, madam. Mirinda, madam. Super awesome. Fantastic. Yes, you are right. Right? Risk, return, and liquidity. See, for all practical purposes, when we talk about investments, these are the three most critical things from investment perspective. Right? Risk, of course, because risk, of course, because at the end of the day, we need to take informed decisions, and we cannot ignore risk, right? Because otherwise it would become speculation. Madam, if you could kindly mute everyone, please, and kindly disable the.
Sir, sorry, we are working on that, sir.
Okay, okay.
For a few
Thank
minutes,
you.
please, sir. Wait.
Thank you.
Sir.
So risk. Yes, madam. Okay. So risks, returns, and liquidity. Right? Now, liquidity is again very important, because let's say if you are investing your money in something and you cannot liquidate those investments, you cannot sell off your investments when you need the money, then obviously the purpose will get defeated, right? So there could be certain investments where liquidity would be very low, right? Certain asset classes have very low liquidity, right? For example, real estate we discussed about yesterday. Real estate, yes, easily and cashable. Very right, madam. You're right. Right? So liquidity is again very important perspective, and returns, of course, it is, and so is the risk. Right? So when we talk about equity markets in detail, we will keep talking about these three elements today as well as tomorrow. Again, what we discussed yesterday, asset allocation is important, because every investor is different, right? No, it's not that what suits somebody else would suit us as well. So we should have our own asset allocation ratios, and we need to keep investing from that perspective, right? That's always good from the perspective of reducing the risk. And today we shall be learning about in more detail. Okay, so let's learn about the asset allocation concept in more detail. Okay, now you tell me, what would the asset allocation ratio depend upon? So let's say me and you, we are two different investors. We will have different investment approaches, right? So what would differ in terms of our what could be the reasons because of which the investment approaches would also be different? What would it depend upon? Fantastic. Absolutely, Nagesh sir. Age, income, goal. Perfectly right. Absolutely right. And welcome, sir. Looking forward to your participation regularly. You are absolutely right. Thank you. Yes, age, the goal, income, right? Somebody whose income is higher can take more risk. Somebody whose income is lower cannot take any risk. Consistency in income, somebody who's in a salary job, who is regularly getting income, can take more risk than someone whose income is inconsistent, right? Someone who has more responsibilities at home, his risk appetite may be lower. Somebody whose responsibilities are lower would have more risk appetite, right? So, so personal situation, family situation, responsibilities, etc. Financial goals, what kind of financial goals would people have, right? Just consider the situation of a 60-year-old person who's not well, but still he has to work, because probably, you know, he has to work to augment the income of the family, right? I know of a particular person whose son got infected with cancer, right? And obviously cancer treatment was costing a huge amount. So this old man had to, you know, work even despite the fact that he was not in the best of health, right? So the situation may have been such, right? Again, risk appetite, as we discussed, somebody whose risk appetite is higher can take more risks, right? Time horizon, how much time do you have? If the time horizon is longer, you can take more risk. But if the time horizon is shorter, right, you cannot take much risk, right? So suppose, let's say a 40.
ஹலோ கிளாஸ் போயினுக்குதுமா, எங்க இருக்க? அது
Participants, please mute yourselves.
Okay. So now let's talk about the stock market and the instruments, you know, that it has, right? So when we talk about stock markets, what we are talking about is we are actually talking about the capital markets. So equity shares, we are talking about the bonds, which is a part of debt asset class, right? Mutual funds is again something which deals with both equity, debt, as well as you can invest in gold also. In fact, now you can invest in real estate also, right? Real estate investment trust, plus derivatives. So futures and options, right? You would have heard about it. So that is again something which is part of the capital markets. Okay. Now, in stock market, there are two kinds of markets. One is called as the primary markets, and the other is called as the secondary market. So let me ask you, what's the difference between primary market and secondary market? Requesting those who have not participated till now to kindly share their thoughts. I am very sure that everybody knows about what primary market is and what secondary market. Oh, awesome. Equity share, preferential share, warrants. Absolutely right, Poonamallee, madam. Perfectly right. Fantastic. Okay. So what is the difference between equity, between primary markets and secondary markets? Fantastic, Dr. Renu, madam. For new issues, we have primary markets, right? And once the issues get listed, then the buying and selling can happen through the secondary markets, right? So just consider Zomato as an example. So Zomato was, you know, held. It was a privately held company, unlisted company. It was, right. Initially, it would have started as a private limited company, and later on, it would have become a public limited company. But still, it was unlisted company, right? So the ownership was held by a few people, right? Now, when they get listed, the ownership becomes widely held, right? by public, by qualified institutions, etc. Right? So when a company gets listed, it gets listed in the primary market. Similarly, when government wants money in terms of government securities, which we shall be discussing day after tomorrow in the debt market, government also comes to the primary market, right? So whenever any new issue which gets listed, comes across in the primary market, right? And later on, once the company gets listed, all the buying, selling, etc., happens through the secondary market. Okay. Now, in the primary market, how does a company get come? So there are two ways. One is called as IPO, right? So IPO means an unlisted company, as the name itself suggests, initial public offering, right? So let's imagine a situation that you are owning a company, right? So ABC company, right? You are owning this particular company, and let's say there are some 50 investors, just for example, who hold this company's shares, right? Now you want to get into the market, right? So you're coming out with an IPO. So what you are saying is that the promoters who are there, right? Let's say they would continue to hold 60% share, and the 40% share would be held by the public. Right? When I'm talking about public, it means the non-promoter. So it would be the qualified institutional investors, mutual funds, insurance companies, etc. Right? It would mean the non-institutional investors. So non-institutional investors would mean high net worth individuals, HNIs, right? And the general public, which means the retail investors. Okay. Non-institutional investors are also part of the retail investors. So these are the people who would be people like me and you who would be owning these stocks. Right? Now the company has come out with an IPO. So this company is saying that, okay, we are now coming out with this initial public offering. We want to become a listed company now, right? And 60% of the holdings would be with the promoters. 40% is what we are releasing for the people, right? So that is what is called an IPO. Now, other situation is, I'll just rub this. Other thing is called an FPO, right? And that's called as follow-on public offer. Right? So follow-on public offer is a particular company who's already listed, right, may require more money. So the company may come out with an FPO, right, again to the primary market, and it will say, we require more money. We want to increase our capital base, right? So when an already listed company again comes to the primary market, that is called as follow-on public offer. Right? Now another term is called as IPO. We have discussed already. All right. So I hope it is clear, right? Let's have a case study, right? Now this case study hopefully should help you totally understand everything about the basics of equity markets. We will learn it with an example, and hopefully this example should clarify everything pertaining to what equity markets actually are, right? So let's imagine a situation that Rajat wants to open a restaurant, right? So Rajat is very fond of cooking. He wants to start his own business. He wants to start a new business, and this business is of restaurant, right? Now Rajat finds out that it would cost him 10 lakh rupees, right? Just a simple example. I know you would say that you cannot open a restaurant with 10 lakhs, but let's assume, just to keep it simple, that it costs him 10 lakhs to open a restaurant, right? Now, Rajat does not have 10 lakhs with him. He has only 5 lakhs with him. So he requires 5 lakhs more, right? So what Rajat does is he talks to 5 of his friends, right? And he convinces them that let us start a new business. I have got 5 lakh rupees with me, right? I will be the 50% owner. I need 5 lakhs more. So can you all chip in 1 lakh rupees each? Right? So his friends agree, right? So Rajat and his friends, they become partners and they start the business, right? Now, out of 10 lakhs of capital, Rajat has contributed 5 lakhs, right? So in this example, because this would get handy later on, what is the paid up capital of the company? What is the paid up capital of the company, of the restaurant? Paid up capital. What's the paid up capital? Total. No, paid up capital of the company. 10 lakhs, right? They require 10 lakhs to open the business. No? So the paid up capital of the company is 10 lakhs. Right? Rajat has contributed 50% of the paid up capital and other partners, other 5 partners, they have contributed 1 lakh each. Right? Now just consider this. The paid up capital of the company is 10 lakhs, right? They distribute, they allocate this particular capital, right, in different shares of 10 rupees each, right? So the paid up capital of the company is 10 lakhs, right? What they do is that they allocate this capital in 1 lakh shares, right? And what is the face value of each share? What's the face value of each share? 10 rupees. Absolutely right. Right? Fantastic. Thank you. Right? So this is how the face value comes in picture. Right? So the face value is 10 rupees. Okay. Paid up capital of the company is 10 lakhs. Rajat holds 50% shares. Okay. So another question. How many how many shares would Rajat be owning? How many shares would be in the name of Rajat? Yes, absolutely right. 50,000. Perfectly right. Right? Fantastic. So as we discussed, the paid up capital of the company is 10 lakhs, right? There are 1 lakh shares of 10 rupees face value each, right? Now, when they start the business, the value of each share is 10 rupees. The face value is also 10 rupees and the market value of each share is also 10 rupees, right? Rajat owns 50% shareholding and each of the other 5 friends, they own 10% each, right? Okay. So each friend owns 10% holding which means they own each share, each of them own 10,000 shares of the company, right? Because they have all contributed 1 lakh rupees. Rajat has invested 5 lakh rupees, and that is why he owns 50,000 shares out of the 1 lakh shares outstanding, right? So this terminology again we will be using later on regularly. So just to repeat at the cost of repetition, the paid up capital of the company is 10 lakhs, right? The total number of shares outstanding. Shares outstanding mean how many shares are there in existence, right? So that is simply speaking the paid up capital divided by the face value of share, right? So the paid up capital is 10 lakhs, right? And the face value of each share is 10 rupees. So 10 lakhs divided by 10 rupees means 1 lakh shares are outstanding. Okay. Please confirm if this is clear, then only we will go further. Because trust me, as you will see later on, if we have understood this thing, no, it will become very easy to understand other things. Fantastic. Okay, others also, please. Okay, great, great. I am assuming, although only 2-3 people have said, I am assuming that everyone is clear, right? Sir, is there any way we could also take the opinion of people who are watching it on YouTube, maybe? If you may ask them to put also in the chat box, and if somebody could check and let me know if they have any doubt, because I don't want anyone to have any doubt left unclarified here, because as you will see later on, if we understand this thing, no, other things will become very easy to understand. All right. Okay, now let's assume that because the restaurant starts doing a flourishing business, right? The market value of the restaurant increases to 20 lakhs. In 3 years, the market value of the restaurant doubles, right? Now there are others who are wanting to buy this restaurant for 20 lakh rupees, right? Because it's doing very good, business, right? So the market value of the restaurant has grown to 20 lakhs. Okay. So tell me, if the market value has grown to 20 lakhs, how much would have the market value of each share gone to? What would be the market value of each share? Yes, 20 rupees. Fantastic. Absolutely right. Correct? So now the market value of each share becomes 20 rupees. Okay. After 5 years, right from the start, in 5 years, the market value goes to 40 lakh rupees. Right? Now, what would have been the value of each share? Yes, 40 rupees. Right? Which means, very simply speaking, when we invest in a particular company, we are investing in the profitability of that company. Right? We want that we are actually becoming a partner in that company, even maybe with a small shareholding, right? For example, you may invest only 1,000 rupees in a particular company, or 5,000 rupees in a company. Proportionately, you are owner in that company to that extent, right? In this case, because each friend invested 1 lakh rupees out of the total paid up capital of 10 lakhs, that is the reason they would own 20% of, 10% of the company, each friend, right? But imagine if somebody were to invest only 10,000 rupees in that company, right? Then this person would be owning only maybe 1% in that company, right? So this is how it works out. This is how the stock value appreciates, right? So as the company starts becoming more profitable, right? As the market value keeps growing, the share price also starts appreciating, right? Now look at Zomato, another example. Zomato's IPO came at 76 rupees, right? The issue price was 76. The reason I'm giving Zomato's example is because it was very recent. It was just last week, and I'm sure we all can relate to that, right? By the way, I have not invested in Zomato share. I'm only giving an example. Okay? So the reason why the value has increased to 135 odd rupees today is because people are really upbeat about that particular business, right? So they think that this business is going to be the business of the future, right? Technology-driven business. Okay, so they are willing to pay a higher price for that, right? Okay, now just imagine that the company, Rajat's company, decides to reduce the face value of the share to 5 rupees. From 10 rupees, they reduce the face value to 5 rupees. This is called as splitting, right? Stock split, S-P-L-I-T, stock split, right? Now tell me, what would be the number of shares outstanding? How much would have the shares outstanding be now? How many shares would be outstanding? Yes, stock split. Total shares. Total outstanding shares of the company. So the total shares outstanding of the company. Originally, what was it? When the company started, the paid up capital was 10 lakhs. Yes, absolutely right. Nagesh sir is perfectly right. Now the outstanding shares would increase to 2 lakhs. Right? Okay. Remember, the paid up capital of the company remains 10 lakhs. The paid up capital of the company remains 10 lakhs, right? Now, because the face value has been split, right? Now, 10 lakhs divided by 5 would mean that there are 2 lakh shares outstanding. Okay, I hope it is clear with everyone. Okay, which means that once the stock split, right, people would get more shares. So anyone, okay, another question. So let's say if I were one of Rajat's friend, right? Initially, I was also one of the partners who had invested 1 lakh rupees in the share in the company, right? How many shares would I would have I been owning now after the stock split? How many shares would I be having now after the stock split? Yes, double to 20,000. Perfectly right. Right? So it's that my share in the capital divided by the face value of the share. Right? I hope it is clear. Okay? Right. So hope you understand the difference between the face value of the share and the stock split, right? And the face value of the share, and what happens when the stock splits, when the face value stands reduced. Okay, theoretically speaking, by the way, Zomato's, any idea what is Zomato's face value? When they came out with the IPO, what was the face value of the stock? Any idea? No, that's the issue price. 76 was the issue, price that they offered. The listing happened at 136. Agreed. I am talking about the face value. No, not 10 rupees. 1 rupee. They came out with a face value of 1 rupee. Right? Each share has a face value of 1 rupee. Right? Okay. Now just tell me, the same company, Rajat's company, what if they decide to split the stock and make the face value become 1 rupee? So in that case, how many shares would be outstanding in that case? If the face value goes down to 1 rupee? Yes, absolutely right. Right? In that case, the paid up capital is 10 lakhs divided by 1 rupee. So 10 lakh shares would be outstanding. Right? 10 lakh shares outstanding, each with a face value of 1 rupee. Right? So this is how it works out. Right? I hope it is clear. All right. Okay. Now just imagine. Rajat's company, the restaurant, is earning profits. Right? Now, when the company is earning profits, right? Just imagine that the total profit that they have earned, right? Let's say is 1 lakh. Right? For a minute, assume that the face value per share is 10 rupees itself, right? Which means there are 1 lakh shares outstanding. Right? So the face value is 1 lakh. Sorry, is 10 rupees. The paid up capital is 10 lakhs. So there are 1 lakh shares outstanding. Right? Now just imagine that the company has made a profit of 1 lakh, which means per share profit, it is called as earning per share. Right? What would be the earning per share? Earning per share is total profit, right? Total profit divided by a number of shares outstanding. So what would be the earning per share? 1 rupee. Right? 1 lakh of profits divided by 1 lakh shares outstanding. We are assuming that the face value is 10 rupees. Right? The original one. Okay. Which means every shareholder is entitled to a profit of 1 rupee per share, and keeping in mind the number of shares that they own, that much money will be payable to them. If the company decides to issue entire profit, right? Company decides to pay the entire profits as dividends amongst the shareholders, right? So this is what we will learn tomorrow, earning per share, etc. Right now, what I'm trying to say is, let's say the company can distribute the profits amongst the shareholders, right? Or what the company can do is that instead of distributing the entire profits, right? Instead of distributing the entire profits amongst the shareholders, the company decides to only pay, let's say, 40% of the profits. Right? The company decides to distribute only 40% of the profit per share, earning per share to the shareholder. The company retains 60% profits, right? And it builds reserves and surplus. right? Instead of distributing all the profits amongst the shareholders, the company decides to build up reserves and surplus, right? Now, what can the company use this reserves and surplus for? How can the company use this reserve and surplus? Right? Yes, for contingency, absolutely right. For emergency, other purposes, for settlement, yes. It may also use it to expand more, right? They may set up a new plant. They may open more offices. They may start a new product. They may also acquire other companies. Yes, modernization. Yes, absolutely right. Right? They may also acquire other companies. Right? Now the company is building reserves and surplus. Right? Now imagine a situation that this reserves and surplus becomes huge over a few years. This reserves and surplus becomes huge, right? So just imagine, theoretically speaking, that 10 lakhs was the paid up capital of the company, right? And the reserves and surplus also grows to 10 lakhs over a period of time, right? Now this company says that we have got enough cash with us. We are not requiring this money right now, right? So what they do is they decide to issue bonus shares to the investors, right? So 10 lakhs was the capital of the company, right? They have 10 lakh rupees in reserves and surplus, right? So what they do is they issue bonus in a 1:1 ratio. So Rajat had 5 lakh shares, right? So Rajat will get 5 lakh more bonus shares. His friends, they had 1 lakh shares each. They will get 1 lakh more shares, right? Now in this case, the stock has not split, right? Stock has not split, but the money would get moved from reserves and surplus to the capital of the company, right? So what is the paid up capital of the company now? After the bonus issue, what is the paid up capital of the company now? Assuming that 10 lakhs, yes. So the paid up capital now would become 20 lakhs, right? And what is the total number of shares outstanding now? What is the total number of shares outstanding now? 20 lakhs, right? So the paid up capital of the company is now 20 lakhs. Sorry, 2 lakhs, not 20 lakhs, 2 lakhs. So the number of shares outstanding is 2 lakhs, right? 2 lakhs, right? So as Matilda madam, somebody rightly said, who said that? EPS will come down. Perfectly right. Somebody said that. Nagesh sir, yes, you are right. So EPS will come down because the denominator has grown. The number of shares outstanding has grown. Right? Fantastic. We'll learn about EPS tomorrow. Okay. So superb. So I hope this makes sense. I'm trying to simplify it. I'm attempting to give simple examples. Hope you're finding it useful. Okay. So when company splits the stock, the face value comes down, right? Number of shares increases. But when the company releases bonus issue, the face value remains the same, but the number of shares outstanding increase, right? So as we discussed, a portion of profit could be distributed among the shareholders. The balance can get flowed back to build reserves and surplus, right? Now the kitty, reserves and surplus kitty, could be used by the company to fund its expansion or to acquire other companies. Sometimes the company also decides to reward the shareholders by distributing the reserves and surplus to them in the form of bonus shares. Right? The company may also maybe come out with a special dividend. Right? Now let me give you an example, a live example of a huge success story in the stock market. And believe you me, there are many, many such stories. Right? So this story is of Wipro. Right? Wipro, we know, is IT company. So just look at it. Imagine somebody investing 10,000 rupees in Wipro in 1980. Right? So somebody invested 100 rupees per share, and the face value of the company of the share was 100 rupees. Right? Let's imagine that the number of shares that were acquired by that person were 100. Right? So this was invested. Now, actually, this is the actual scenario. 1981, the company came out with 1:1 bonus. Right? So the company issued equal number of shares to all the existing shareholders in a 1:1 ratio. Means if you had 10 shares, you will get 10 more shares. Right? 1985, again, they came out with 1:1 ratio. So somebody who had 100 shares in 1981 became 200 shares. Somebody who had 200 shares, because of 1:1 bonus, the number of shares increased to 400. Right? Then the company split the stock from 100 rupees, face value got split from 100 to 10. Right? So those who had 400 shares now had 4,000 shares. Right? As we learned. Again, the company came out with 1:1 ratio. Right? So those who had 4,000 shares, this person who had 4,000 shares now has 8,000 shares. Right? Again 1:1 bonus, again 1:1 bonus, again 1:1 bonus. 1997, the company came out with 2:1 bonus. 2:1 bonus means somebody who had 1 shares, right, got 2 more shares. Right? So look at it. 64,000 shares, the person got 1,28,000 more shares. Right? So from 64,000, this became 192,000 shares. Right? 2:1 ratio. Bonus. Okay. 99, the stock split from 5 rupees to 2 rupees. Right? And this number of shares of 192 increased 5 times. Sorry, 2.5 times. Right? So this came to, sorry, from 10 rupees, it came down to 2 rupees. So 5 times, right? So this became 960. From 192, it became 965 times, right? Then the company again came out with 2:1 ratio bonus, right? So 960 became double the shares were issued, free, absolutely free, right? And this became, the total shareholding became 28,80,000. Okay, 2005, again it came out with 1:1 ratio, right? Look at the impact. 2010, the company came out with 2:3 bonus, which means for every 3 shares, right, you get 2 more shares, right? So in case somebody had 30 shares, now we'll have 50 shares. Right? Against 3 shares, company issues 2 more shares, bonus shares. Right? And 2017, again 1:1 bonus. Right? Which meant from 100 shares, just because of bonus and split, the total shareholding increased to 38 lakhs, sorry, 3 crores 87 lakhs 16,700. Okay, now, this is not all. Actually, this picture which I took is only till 2017. Later on, in the year 2019, the company again came out with 1:3 ratio. 1:3 ratio means for every 3 shares, one additional share was issued, right? Which meant that if somebody had, had 30 shares, will now have total 40 shares, right? So this meant that the number of shares increased to these many. Okay, and total number of shares, considering that today the value of share is 601 rupees per share, this means that 10,000 invested grows to 3102 crores. That's a real story, right? 3 lakh shares grow to in amount, 100 shares, they grow to this much number, 5 crore 16 lakh 22,267, which today, as per the value of 600 odd rupees, works out to 3,100 crores, right? That's the power of wealth creation, which equity gives you, right? So I hope the case study pertaining to the bonus and split would have helped you to understand this concept. Okay. Now let's understand the risks in the investments, right? From a stock market perspective. So we learned about allocation ratio. We said that you should not put all eggs in one basket, right? But can you eliminate all risks through diversification? Tell me, can we reduce all risks through diversification? No, right? We cannot reduce all risks through diversification. We can reduce only those risks which are called as unsystematic risks. Okay, let's understand what systematic risk and unsystematic risk. See what happened last year in pandemic, right? If you recall, in March, I think it was 20th of March, 25th of March, I don't remember. The stock market had really plummeted down, right? And all stocks got impacted, right? So systematic risk is the risk which impacts the entire market, irrespective of Rajkumar sir, kindly mute your microphone, please. Thank you. Okay. So systematic risks are those risks which impact the entire market, irrespective of a certain industry, irrespective of a certain business, right? So these risks are caused by the macroeconomic environment. It may caused by political factors, right? Just imagine a particular country is invaded by the enemies, right? Or there could be some political issue. The government is not stable there, blah, 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 right? So this may bring huge volatility in the market, right? So these risks cannot be reduced through diversification, because these are called as systematic risks, right? They cannot be reduced through diversification. Unsystematic risks are those risks which pertain to one particular industry or one particular business. For example, a particular company may have a strike, the workers may strike there. Or for example, Jet Airways closed down, right? DHFL could not pay back its debt, right? Kingfisher, Mr. Vijay Mallya's company, obviously they were not able to pay the debt, right? So these are unsystematic risks which pertain to one industry or one particular company, right? These can be reduced through diversification. So instead of you investing entire money in Jet Airways, you diversify your investments across different businesses, right? So this is an example of business risks. So business risk would pertain to one industry, for example, right? So they can be reduced. Unsystematic risk can be reduced through diversification. Systematic risk cannot be reduced through diversification. Okay. So what are systematic risks? Examples: interest rate risk, right? Market risk, exchange rate risk, political risk, right? So normally pertain to the macroeconomic environments. What are unsystematic risks? Financial risk. A particular company may not be able to do its business properly. It may not be able to pay its loan properly, right? Business risk means the company is not able to run the business. For example, Jet Airways. So Jet Airways faced both business risk as well as financial risks also, right? It could be management risk. Satyam, if you recall Satyam, Mr. Ramalinga Raju, right? Mr. Ramalinga Raju committed fraud in the company, right? I'm sure you may remember that 2009, early 2009, right? That was a management risk, right? Now, all those investors who may have invested big amount in Satyam company, Satyam Computers would have got impacted phenomenally, right? If they had not diversified, obviously they may have suffered huge losses, right? Yeah, Mr. Ramalinga Raju, he embezzled money and manipulated records. Yes, madam. Okay. So we can reduce the unsystematic risks through diversification. We cannot reduce the systematic risks, but the total risk does get reduced, right? What is total risk? Total risk is systematic plus unsystematic combined, right? Systematic you cannot reduce to diversification, but unsystematic you can reduce to diversification. This way the total risk does get reduced. Right? Now see, the fact of the matter is that economic cycles would be impacting us. Okay? Economic cycles means that we will have ups and downs in the economy. We will have recessionary phase in the economy. It would lead to recovery phase. It would lead to recession, right? Just like we say, in our personal lives also, we go through ups and downs. We all face problems in our life, right? And I am sure when we talk to elders or other family members, everyone assures us that it's just a phase. Just hold on to it. Just fight back. And good days will come back again, right? Same is the case with economy. But unfortunately, what happens is many investors, they get worried when they see the stock market going down or when they see recession coming in, right? They think that they should get out of the stock market. Actually, those people, as we will see later on, who are able to remain invested during this phase and they keep investing regularly, they would be able to create more wealth, right? That is why not everybody is an investor. There are many people who are speculators, right? Who would only invest when the market is going up. But when the market starts going down, they ignore it. I mean, just to share with you, about 10 days back, my wife read a news in shorts that in a marriage ceremony in a particular state, at the time of that Jaymala, when both the bride and the groom they exchange garlands, right? The wife, that lady, the bride, collapsed, right? She became unconscious or don't know what happened. The groom, instead of supporting her, he ran away. I don't know whether you guys read that or not. The groom ran away, right? Similarly, there are many investors, they run away from the market. They think that, they are going to see a doomsday and bear market, and they run away from the market, right? We need to understand that it's a part of life. We will have ups and downs, right? Yeah. So we need to understand that. So let me give a live example to you. See, history bears testimony to the fact that we have had many incidents where the market came down drastically, right? But ultimately, after every downfall, after some time, the market again recovered, right? And the recent example in front of us is the COVID last year, right? And just imagine now we are at the highest levels, in Sensex, our indices are at the highest level, right? So this is what the reality is. That's why from a stock market perspective, if you are investing money, you need to have a long-term perspective, right? Again, another example, as I shared with you yesterday, the average returns in the BSE Sensex are over 16%, right? Over the last 26 years from 94 to 2009, the average returns were 14.5%. The average returns were 14.5%. But does it mean that every year the returns were 14.5%? No. As you could see in this particular slide, there were very few periods in which the actual returns were close to the average, right? So 94, it was 14.3. 2004, it was 12.4. 2010, it was 17.4. 2019, it was 14.38, right? In most of the periods, it was way apart, either positive or negative, right? Look at it. 99, it was 63%, right? Then it went down to minus 16%, right? It went down to minus 52% in 2008. Then 11, 12, 11, sorry, again, it went down to minus 25%. Now just imagine if certain investors, they had, exited the market during these times, they would, and if they had not invested during these times, those people would not have been able to reap the fruits, right? Only those people would have been able to reap the fruits who may have had a long-term approach, who may have kept investing across all periods. That is why systematic investments really benefit a lot, right? Because when the markets come down, you are able to acquire the, investments at a much lesser rate, right? And when the market recovers again, obviously you will be able to reap the benefits, right? So fantastic. This was a WhatsApp message which I got. On a daily basis, the volatility in the market would look like this. But when you look at it over a decades period, right, from a long-term perspective, it would look like this. Now, the choice is ours, whether we want to look at it from a short-term perspective or we want to look at it from a long-term perspective, right? Of course, when we do trading, in case somebody were to do trading, yes, we have opportunities in intraday, right? So let's say somebody is able to forecast that, that intraday value will come down from this level to this level. The person can make profits. If somebody can take position, sell position intraday at this level when the target is kept at this level, there are opportunities. But then from an investment perspective, you have to look at it from a long-term perspective, right? I hope this is clear. Okay. Now let's understand, why do investors behave in a manner that they normally behave, right? Why is it that certain investors, they exit the market when the market goes down? Or why is it that investors many times become greedy, right? When when an IPO comes, probably they may take loans, they may take personal loan, and they may want to invest just because they think that they will have huge listing gains, right? Why is it that people become too fearful at times, and why is it that they become excessively greedy at times, right? That is because, our brain, may make us behave in that manner, right? So we may behave in a manner, we may let our decision making get clouded, right, by such factors, and that is the cognitive bias we will learn about, right? So any flawed perceptions which may come in a person's mind, which may not allow them to take the right decisions, right? Let us look at those factors. See, the first one is overconfidence bias. Many times we have overconfidence on us, right? For example, we may get into a class without much preparation. We may, go to play a cricket match without much preparation, right? We may invest money in a particular stock without reading about it, just because we have this confidence that I can never go wrong, right? I may tell myself, Ravinder Singh Chawla, you are a fantastic investor. Whatever you put your hands on turns into gold, right? I may have that misconception about myself, right? Similarly, we generally give credit for everything that goes well to ourselves, and if anything goes wrong, then we blame the environment, right? Or ultimately, we will blame the Almighty, or we'll blame the luck, right? So all credit is given to us ourselves, but we will not take the blame normally. We will pass it on to someone else, right? Again, consensus bias, we try to follow others, right? We have this herd mentality. We look at what others are doing and we try to follow them. So that's a consensus bias which is there, right? Again, we may not want to take slight risk just because it may give us bigger gain, but we may try to ignore the risk altogether, right? Remember the trinity of investment: risk, return, and liquidity, right? Now, if you if you say that I don't want to take any risk, then that is also not right, no? Imagine you buy a new car, but you don't take that car on the road. You keep it in your garage itself just because you think that if I take it out on the road, my new car will meet with an accident, right? So I'll keep it at home itself. Then what's the purpose of buying a car, right? We will have to take calculated risks. We'll have to do proper study, right? But if we just say that no, I will not take any risk, then it is like I would only want to put my money where I get assured return. So if you want assured return, guaranteed return, then that's not investment, right? Again, framing. Okay, let me ask you a question. Let's say you get two gifts on your birthday, right? You get two gifts on your birthday. One gift is nicely packed, right? It's packed in a very attractive paper, glazed paper, with a very attractive, ribbon packing, and it looks awesome, right? Other gift is packed in a newspaper. And just imagine, it is tagged with a rope, right? With a rope, cute rope. Right? You tell me, which one would you think is a more expensive gift? If somebody were to ask you which gift you can attractive one, right? We may think that probably the attractive gift is more, expensive one, and the one which is wrapped in a newspaper is not a. So we tend to base our opinion in terms of how it is packed or how it is presented, rather. Right? So if a particular report is in a very good manner, if you see banners, right? In my childhood, I remember my mom used to tell me that I always used to insist that we'll go to a shop to buy things from where the lighting is very good. Right? I used to say that this is a good shop. Right? So many of us, we get impacted that. We look at the advertisement, we may look at how it is presented. Whereas it may not be so. Again, we use pre-existing biases, use pre-existing. For example, if my father never invested money in the stock market, because my father, imagine, example, my father used to say that, stock market is very risky. I lost money in the stock market. Probably I may also not invest in the stock market because that's the kind of anchoring bias which is there. I might assume that because my father lost money, I will also not invest in the stock. That's one reason why people love fixed deposits so much, because they assume that anything which is guaranteed is better. We tend to base our decisions on the fact whether we know something or not. For example, if I have been investing in Reliance, right? I have invested in some other company, I would tend to favor that particular company because I'm familiar with it. I would not want to invest my money in another company which I'm not familiar with. And just imagine you go to a party, right? And you see all strangers there, but you find someone whom you may be knowing, right? You straight away will go to that person, won't you? Because you know that person very well, isn't it? So that's a familiarity bias, which is again, we tend to form decisions on the basis of confirmation bias. For example, let's say Zomato or let's say another company IPO has come, right? Now you want to invest there, but you're looking for confirmation from some. So you ask a colleague, okay, yaar, you tell me how is that particular investment? Should I go ahead? Now, if this person tells you, yeah, go ahead, I'm also going ahead with it, you will immediately take a decision. Right? Because you're looking at confirmation. Maybe that person does not know anything about that investment at all. Just because that person is saying yes, you may take that decision. Right? So these biases do not help us. All right. Let's now learn about some commonly used terms in equity markets. Right? So we shall learn about stock indices, Sensex and Nifty. Right? We shall learn about market capitalization. We shall learn about the free float market capitalization. Right? And we shall also learn about large cap, mid cap, small cap. Okay. Since we have already done that case study, hopefully this will become little easy to understand. What is market capitalization? Any idea? Can anybody share what is market capitalization? Yeah, what is market capitalization? Anyone, please? Market capitalization is the market price of the share multiplied by the number of shares outstanding. Right? Now, in that example, Rajat's example, case study that we did, imagine that the, after 5 years, we said that the stock value would rise to 40 rupees, right? So, for 40 rupees or 50 rupees, whatever we, right? So, 50 rupees multiplied by number of shares outstanding was 1 lakh, right? So, 50 lakhs was the, 50 rupees was the share value multiplied by the number of shares outstanding was 50 lakhs. So practically speaking, market capitalization is how much does the market think this company is worth. Right? So when we said that Rajat's restaurant was worth 50 lakhs, so 50 lakhs, right? That is what the market capitalization was. The share price multiplied by number of shares outstanding. I hope this is clear. Okay. Let's say a company's share price is priced at 200 rupees and the number of shares outstanding are 200 crores. Right? Which means, let's say the face value of the company is 10 rupees, face value per share is 10 rupees, and the paid up capital of the company is 2000 crores. Right? So in that case, 200 crores would be outstanding shares. Right? In this case, what would be the company's market cap? Yeah. So what would be the market cap of the company? Yes, please. Simple, no? 200 multiplied by 200 crores. 40,000 crores. Right? Yeah, 40,000. Okay. So market price of the share multiplied by the number of shares outstanding. Now, what is mid cap, large cap, small cap? So just imagine, suppose you were to list the companies in terms of their market capitalization in a descending order, right? So Reliance has maximum market capitalization, so that will be in first rank, right? So this way, if you were to list down the top 100 companies in the order of their market cap, those 100 companies are the large cap, right? So the first 100 companies in terms of market cap are large cap. 101st rank to 250th rank, they are referred to as mid cap companies, and 251 onwards, right? They are ranked as small cap companies. Simple. I hope it is clear. Right? Any questions here? Is it clear? Is it clear, please? What is large cap, mid cap, small cap? Yeah, thank you. Okay. Okay, now we have learned about market capitalization. Let us learn about free float market capitalization. Remember, we learned about liquidity, right? Now, just imagine a particular company which has got very less number of shares available for trading, available for buying and selling. Would the company have high liquidity? Will the stock of the company have high liquidity? No. Which company would have which stock would have high liquidity? Where the free float is larger, right? Free float, very simply speaking, means how many shares are freely floating. Freely floating means how many shares are available for regular buying and selling, right? So number of free float shares multiplied by the market cap of the company is what free float market capitalization is. Okay? Let's take an example. Let's say a particular company's promoter holding, the shares held by promoter and promoter group, is 55.37%, which means that 44.63 are available with the public. right? The non-promoter group, which means these are available for regular buying and selling, right? So this is what the number of shares, 233.51, is the free float number of shares outstanding is, right? This multiplied by the market price of the share would be the free float market capitalization, right? So another example, let's say the total number of equity shares of the company is 250 lakhs, 0.5 crores, right? But let's say only 48.44 are available, right? So 2 crore 50 lakhs are the total shares outstanding, but only 44% are available with the public, right? So 1 minus 0.844 means the balance 48%. This is what would constitute the free float out of the total number of shares. Right? This multiplied by market cap, this multiplied by the price of the market price of the share is the free float market capitalization. Just to repeat, market capitalization would include all the shares outstanding, but free float market capitalization would only include those shares which belong to the non-promoters, which are available for regular buying and selling. Let's now learn about stock indices. So you would have been seeing in the newspapers that Sensex has gone up, Sensex has gone down, Nifty has gone up, Nifty has gone down. So what exactly is Nifty? What exactly is Sensex? Let's learn. So Sensex is an index. It's an index. It's an indicator, right? It's an indicator. So it's an indicator, like for example, in your class, just for example, if in your class, or let's say you are an HOD, right? And in your department, 90% students have passed the exam, right? But let's say in another department, only 85% students have passed the exam. So what does that indicate? That on an average, your department has done better, right? So it's an indicator. Now, this indicator is based on a basket of 30 stocks, Sensex, right? Nifty is a basket of 50 stocks, right? So whether 30 stocks in Sensex or whether 50 stocks in Nifty, they are allocated in terms of certain weightage. Okay? We will see in the next slide. So Nifty 50, right? Out of 50 stocks in Nifty, the total weightage is 100% for 50. But out of 50, 10 stocks, their total weightage is more than 58%, almost 60%. Right? 10 out of 50 stocks, their weightage is almost 60%. So which are those stocks? You could see the list here. Okay? Now just imagine a situation that in a particular day, right, all these stocks, they end up higher. They open at a lower rate, they close at a higher rate, right? Which means these particular stocks, they end at a higher value at the end of the day, right? Now the total weightage of these shares is almost 60%. It is more than 50%. So that day the stock market would be higher, right? Even assuming that the balance 40 stocks in Nifty, even if they were down, just because these 10 stocks whose weightage is more than 58%, they ended up at a higher value. the stock market that day, in terms of the index, right, would end at a higher. It's an indicator. Similarly, if these 10 stocks end at a lower value, despite the fact that the other 40 stocks would have ended up at a higher value, that day the market would go down. Right? So when you hear the term that the Sensex went down, it does not mean that the entire stock market went down. Right? So these stocks, right, represent certain sectors. In terms of the weightages, these sectors have these kind of weightages. So maximum weightage is of financial services sector. Now just imagine if, let's say, there is a boom time in the financial services sector, right? Then all these financial services stocks would do well. And because their weightage is as high as 37%, the chances are that the Nifty would be doing very well, even assuming that the other stocks are not doing well. Conversely, it is quite likely that financial services sector is not doing well, right? Then even assuming the other sectors are doing very well, still the index would be down, because the weightage of this particular sector is the highest, right? In fact, that's why I wanted to share with you that maximum jobs are also going to be coming in the financial services sector, right? So those of you who are the faculty members in arts and science, kindly do support your students to acquire skills pertaining to the financial services sector, right? Because maximum jobs are going to be in the financial services sector in terms of percentage, because the weightage of the services sector in GDP is very high. Not weightage, sorry, the contribution of the financial services sector in GDP is the highest. Similarly, Sensex is a basket of 30 stocks. But here also, if you see these 10 stocks, Reliance, HDFC Bank, Hindustan Unilever, Infosys, ICICI Bank, HDFC Limited, TCS, Kotak Bank, L&T, Axis Bank, their weightage is almost 60%. The same thing is applicable here also. If these 10 stocks do well, that day Sensex would be ending up higher. Right? So again, the same thing in Sensex, the banks have a weightage of 28%, right? Housing finance companies have a weightage of 7% because of HDFC Limited, right? And NBFCs have a weightage of 2.6%. So again, 37 odd percent happens to be that of financial services sector. All right, so this is what we learned today. We wanted to learn about investment versus speculation. The premise for equity market, so that is why we built that case of Rajat opening a restaurant, and I wanted to talk about what is paid up capital, what is the face value of the share, what is bonus issue, what is split, right? How does share value actually increase, right? So hope you would have found that useful. We also learned about different asset classes, risks and investments, the systematic and unsystematic, and cognitive biases in investors, and the commonly used term in equity market. Tomorrow we'll get to the next level. We'll learn about more things in more detail. Obviously, standard would be little on a higher side. Now, since you have understood about the basics, right? So kindly do not miss tomorrow's session. And I am all set to answer any questions that you may have. Yes, please. Sir, if you could kindly help me understand any question that participants may be having.
Participants, kindly unmute yourself and ask questions, or you can post it in the chat box.
Okay. Does capital reduction can be related as stock split? Stock split pertains to the face value of the stock being reduced, right? But imagine if, theoretically speaking, let's say the company decides to reduce the capital base, right? Then in that case, that's not a stock split. Honestly, in the real world, paid up capital of the company wouldn't reduce, so to say. It's quite possible that the company is making losses, right? So in that case, if the company is making losses, the promoters may have to infuse more capital. Look at what is happening in Vodafone today, Vodafone Idea, in case you are following that. See, they owe huge amounts of money to the government, right? They do not have money, so they are looking for funding, right? Now, how can company get money, capital? How can they choose more capital? Either they will come out with, either they will have to borrow money, they'll have to take loans, right? Or they will have to issue shares to other companies, right? So either they can raise money through equity dilution, right? The promoters say that, look at now public sector, LIC, right? Now, as of now, LIC is 100% a public limited company. I mean, it's a government company. Government is the 100% owner. Now, government needs money, right? So the government is divesting its stake in the public sector companies. So LIC's IPO would be coming. They would also be divesting their stakes in other PSUs, right? So what the government would be doing is the government would be reducing its ownership and would be releasing the, let's say the government says that 75% is what we will retain, 25% in LIC is what we will give to the public, right? Then IPO that will come in the form of 25% to the public, right? That is what it is. Any other question? I hope Ms. Kalyani or Dr. Kalyani, sorry, I don't know. Have I been able to answer your question? All right, all right. Any other question, please? You know, in training circles, and I'm sure, I'm sure you would also know about it since you are professors yourself. When there are no questions, either it means that everything is clear, everything has been understood, or it means everything went over the head and nothing was understood by anyone. So that's why there are no questions. So it's only one of the two options. Okay, 5% best in government, but remaining 95% policy. See, that is in terms of how the bonus will be distributed. So whatever profits are earned by the corporation, in case of the with profit policies, right, 5% is retained by the shareholders and 95% gets distributed amongst the policyholders. That's a different thing. I am talking about the ownership in the company, right? So LIC has 100% ownership of the company, of the government as of now. What you are referring to, Poonamallee, madam, pertains to the the bonuses which get distributed by the insurance company. You're absolutely right that their whatever with profit policies, whatever they earn, 5% is retained for the shareholders, is given to the shareholder, and 95% gets distributed. All right, if there are no more questions, I'll okay. I hope you found this session to be useful today, because this is a complicated topic. I have attempted to make it simple for everyone to understand. I hope you found it useful. All right, thank you. Request others also to please share it. In case there is something which is not clear, please do let me know. I'll try my level best. I'm sharing the link for today's quiz. Thank you. Thank you. Appreciate.
Thank you very much, sir.
Again, a gentle reminder, kindly mention your name, right? Please do not mention your email ID in name, one. And secondly, please submit your answer only once. Please do not submit it again. You will get a confirmatory message once you have submitted it. So please do not send it again. Thank you.
Thank you very much, sir. Can you hear me?
Yes, madam, I can.
Yeah, the session was really informative, sir. It was interactive as well with a lot of practical examples, and it was comprehensible for even a novice like me. I too had learned a few things about investment management today. And thank you very much, sir. And the thankful receiver bears a plentiful harvest, said William Blake, a famous English poet. As thankful receivers, we are overwhelmed to express our sincerest gratitude to you, sir. And for that, I kindly request our professor, Dr. E. Sambasivam, Associate Professor and Head, Department of Commerce, to propose the vote of thanks. Sir, over to you.
Good evening, one and all. Respected and our more distinguished chief guest, Mr. Ravinder Singh Chawla, most respected principal, Dr. Malati Thiruverkadu, respected director, Sai Satyavadi, honorable professors, colleagues, and my dear friends. I have deemed it great honor to propose the vote of thanks to all who have helped us in making today's webinar such a resound success. First of all, I would like to propose heartfelt vote thanks to our correspondent, Mr. Venkatesh Raja, for his moral support and guidance. I would like to propose two handful vote of thanks. Our chief guest, Mr. Ravinder Singh Chawla, founder and managing partner, RSC Skill Building and Consulting Solutions, for gracing today's webinar. Thank you, sir, for your very much interesting and thought-provoking address. Like 2 years before, one of the poetry in Thiruvalluvar, our Thirukural, Illare Ellarum Elluvar, Silvarai Ellarum Seivar Sirappu. It means, பொருள் இல்லாதவரை எல்லாரும் இகழ்வார்கள், செல்வரை எல்லோரும் சிறப்பு செய்வார்கள். All despise the poor, but all praise the rich. So same likewise, our speech. அளவறிந்து வாழாதவன் வாழ்க்கை உளபோல இல்லாகி தோன்ற கெடும். It means the prosperity of him who lives without knowing the measure will vanish away and price, even while it seems to continue. So
thank you.
Your case study is like that, sir. Thank you very much for your wonderful classes, very useful to every human being, sir, today life. Then I would like to express our profound gratitude to our principal, Dr. Malati Thiruverkadu, for her interest to conduct the webinar for our benefits. Then I would like to thank our director, Dr. Sai Satyavadi, for her supporting and guidance. Then I would like to thank the coordinator, Dr. S. Ganapati, for all the day events for making this webinar a great success. Then I express my vote of thanks to our staff members and colleagues who have made today's webinar a grand success. Then one of our great poetry in Bharatiyar, dreams comes true. காசி நகர் புலவர் பேசும் உரைதன் காஞ்சியிலே கேட்பதற்கு ஒரு கருவி செய்வோம். Like that, today I would like to thank for our technologists and technicians for supporting the webinar for grand success. I would like to thank all participants from various institutions and companies. Thank you so much for your cooperation. Once again, I thank all your cordial cooperation in future. Thank you. Thank you very much.
Thank you, sir, for your warm and kind words. Now, as we have come to the end of the session, I would like to again remind the participants to attempt the quiz before 5 p.m. And thank you, sir, for enlightening us. I thank each and every one of you who participated in this session today. Thank you. Let us all meet tomorrow for yet another illuminative session. Thank you. Have a happy evening. Thank you, sir.